This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning Charles Hugh Smith, well-recognized and prolific writer on the web, who is also the publisher of the website of2minds.com. And welcome back, Charles.
Good to be here. Thank you.
Charles, we had a great session earlier this week with Bill Wagner, and I very much enjoyed it. He referenced a number of times, for those that have listened to that session, the article we're going to talk about here this morning, the Global Endgame 14 points that you wrote. I have to compliment you. It's just an outstanding article.
Thank you, Gordon.
You've really consolidated, and you mention in it the number of articles that you've written that were a foundation for pulling it together. So I know you brought some slides so that we don't run out of time. I wondered if you could just take us through them so we could really kind of crystallize some of the things that we've talked about in previous shows.
Great. Yeah, let's look at the first slide. It's called the Global Endgame in 14 Points. And I think just to provide the context, we all know that there's a business cycle. In other words, an expansion of production and credit and investment that builds growth in the economy, and then at the end of the business cycle, it rolls over and credit is renounced, or bad credit is written down, and production facilities which are no longer productive get liquidated. And so we're used to the idea of a cycle. And what we're really facing here is because of the governments around the world, they want to basically get rid of the business cycle. They don't want any recessions or contractions of credit and production. They only want growth. And so they've poured money and credit into the system to try to get rid of the key function of capitalism, which is creative destruction and destruction of bad credit and unproductive assets. And so that's created a situation where we're not cycling just up and down. We're reaching an end game. We're an end point where the system will break. And so that's sort of the context of the 14 points. And so the first 3 points are, in the beginning of a credit expansion cycle, people borrow and they invest in productive assets that increase everyone's wealth, and the assets go up in value because they're creating profits. And Gordon, you've often spoken to that this expansion is based on increasing profits, increasing productivity, like it's the real thing. It's not like an asset bubble. And in the beginning phase of this kind of expansion, people tend to invest in material production, in new factories, in new railways that move material at a cheaper rate, and in other words, highly productive material assets.
These are also products, Charles, from a mercantile standpoint, whether they're part of the supply chain or not, but eventually end up with products that are exportable. So they're products that, in fact, then support the society's consumption levels, so that in fact we're producing more than we consume. So these are real, innovative, creative, new wealth-generating ideas, and they deliver profit, which is new capital, and is where our traditional capital system and our typical business cycle works. That's when it's operational.
That's right. And then the point 3 here is when the cycle turns down in terms of material production, like there's already enough factories producing stuff, and it's just harder to generate high returns on investment in material production, then capital flows to financial assets and financialization. In other words, it makes money with money. And this is a trend that's actually been repeated in the history of capitalism for hundreds of years, that we can go back to the 14th century, and when Venice, the mercantile class in Venice, was no longer able to generate big profits with trade, then they bought land on the mainland and became basically rentier farm owners. That they so they went out of high yield and they went into like financial playing around. And so this is a cycle that has been repeated, and eventually that financial assets create bubbles, and then when the bubbles burst, then you get a recession or a depression, and that's when bad debt and unproductive assets are liquidated, and then that sets up the next cycle. So in that sense, financialization is part of capitalism, but what we have is a financialization that's run off the rails. It's completely untethered from the real economy. And this next slide, which shows the global financial assets, and what it shows is an incredible like quadrupling of global financial assets from 1990, when it was around 50 trillion, to like 200 trillion in 2007. And so, and then since then, it's stagnated. Despite massive increases in money supply and credit, global financial assets are about where they were 5 years ago. And so this shows the diminishing returns on financialization.
Charles, you've done some other great work on what you've always referred to as the S-curve, this whole financialization of our markets. And I have a chart here that's a diagram of a cycle, and it's kind of another S-curve, and it's the cycle of deflation. And this particular diagram is one that I've used for years. It's put out by the Comstock Partners, and I got to give them full credit because they were putting this out back in the late 90s before the dot-com bubble burst. They used to write on a daily basis, and they were saying where they saw things going and why. And it's played out, and I kept this chart all the way through the 2000 because it's been a superb roadmap, and it shows what happens in a normal cycle of deflation. And the point I'd make is your S-curve maps right onto the top of that chart, the very top of excess capacity. Then we get weakness in pricing power. But the difference here from this chart, this was based on this cycle of deflation on what I'll call the industrial age, the normal business cycle. And in fact, in the industrial age, when we had a gold-backed currency for the vast majority of it. And so, but it's not based on the new world, and the new world of financialization that you've written so well on, and living in a world of a fiat currency. So the question is, will it unfold as this chart appears to with a cycle of deflation, or is it going to unfold in a different manner? And as we go, we're on point 3 here. As we go to point 4 on your 14 points, you're really reflecting what's happening in this new world, which is different. And as we go through, I hope our listeners will be able to start to see this tremendous change that's happened as credit, not money, but credit that's now appearing through the shadow banking system and other intermediaries versus the traditional creation of the monetary base is so fundamentally different. Sorry to interrupt there, Charles, but I just wanted to make sure we have a platform here to see how profound and significant the points are that you put together in your article.
No, I'm very happy you brought that slide, because it shows that there's the real economies, which still exists in the U.S. People are still growing soybeans and selling them and making things, and but the real economy has been superseded by this credit-based economy. And so point 4 is that initially financialization generates enormous profits as credit and leverage expand far faster than the real economy. And listeners know that you have often explained, credit default swaps and all these sort of like financial tricks that generate giant profits without actually making anything. And so at some point, this expansion of credit and leverage outpaces the real economy, and that creates asset bubbles. And what the housing bubble was a perfect example, that you get marginal borrowers who really wouldn't have qualified for a mortgage 10 or 15 years ago. Suddenly they can borrow hundreds of thousands of dollars and even buy multiple homes. And so then all these marginal buyers can have access to all this massive credit. Then, of course, the assets bubble up, and then that creates phantom collateral. In other words, somebody bought a house for $300,000, and 6 months later it's worth $400,000. Then they buy another house, leveraging the money they made on the phantom collateral, And we call it phantom because, of course, all asset bubbles pop, and then the collateral is recognized as being phantom, and then the whole house of cards collapses. The next slide we're looking at here is just to show the level of debt in the world economy, and that we hear about sovereign debt, like the Italian and Spanish bonds, but there's like a tremendous amount of corporate debt and household debt and shadow banking debt and sovereign government debt. And so you're looking at these economies that have like the Britain or Japan that have 500% of their GDP in debt, and the rest of us are at 300 to 400%. And this is completely unsustainable. You cannot have an economy leverage 3, 4, 5, 10 times as much debt when the economy is not growing. There's no basis for additional growth in that credit. And if we could, this next slide is point 7 and 8, which is that the borrower's assets vanish as these asset bubbles pop, but the debts they took on remain to be paid. And that leaves the governments and the central banks with some very limited choices. Either the debt has to be paid down with heavily depreciated currency. In other words, the government has to depreciate the currency so that we're paying back this immense debt with cheaper money, or it has to be rolled over, which we spoke about in our last show, that tremendous amounts of debt are just being rolled over. They're not being paid down. Or the debt has to be flat out renounced, written down, written off.
Charles, that was the choices we went through in 2008, 2009. A public policy where, in fact, we chose not to write down that debt. We chose to bail it out and pass it to the taxpayer, in effect, and around the world. So too big to fail became the fact that we didn't break up these banks, in many cases, put them into bankruptcy and split off the assets. So we had public policy choices to make it at point 8. And we've made those choices, but they're behind us now, and now we're living with the consequences of what they led to.
Yes, and unintended consequences. If we could move to the next slide, to point 9, what happens in asset bubbles is that wages remain stagnant because its productivity in the real economy is not being boosted, and so what everybody starts depending on is the speculative increases, speculative profits. The government depends on capital gains for like their tax revenues. And so everybody's sort of committed to this game. And so the central banks really, from their point of view, have no choice but to unleash wave after wave of basically free money, like credit, liquidity, money supply. They just pump the more and more money into the system to keep it afloat.
Which is, I think, what we've in 2011 and 2012, where we clearly arrived at, where we really went to flat-out quantitative easing and the sizes and the scope across all the central banks of this,
yes.
Of no choice as these quantities of the size of balance sheets increased at larger amounts and faster rates.
Yeah, and then what happens, Gordon, as you well know, is that there's no incentive to actually build a factory or something productive, because that always entails risk. I mean, that's the nature of capitalism. But when the central bank pushing the wind at our back, so to speak, then that's actually incentivizing investment funds to speculate in risk-on assets like equities and bonds and now real estate again. And so it's this whole policy actually fuels highly risky and unproductive uses for all the money.
Well, that's the essence of the macroprudential strategy that's been implemented called financial repression, is in fact because you need to force your interest rates down across the whole yield curve, durations, to negative real rates. And by the nature of chasing yields, it's going to force people into riskier assets. Those riskier assets are going to be in the securities market, which is in fact what we've seen as we've had this massive change for a chase of yield as on funded by cheap money. Natural consequence and fully predictable. And frankly, I would argue, was an understood public policy decision that was understood when it was taken. They knew the path that this would lead logically to.
Yes. And they were engaging in magical thinking, really, that this would somehow escape the end game here.
In support, I believe that they were the central bankers. They knew what this meant. I don't believe, in general, the politicians understood it. They just wanted a quick fix. And yes. I believe that these central bankers were doing it more because it was the only way out. If there was going to be no public policy, monetary policy became the only solution. And I'll be the last person to defend the central bankers, but they became the only game in town. And so they've assumed all this responsibility and have become perceived to be omnipotent, and they're not. And they don't have the tools to solve the problem. So we're flogging the same dead horse, and this is almost a natural consequence.
Yes. And let's go to point 12 on the next slide. This creates, there's a diminishing return factor here. And I think that's one of the key dynamics we have to understand, that the more credit they pump into the system, the amount of actual GDP growth or income growth that creates, it gets smaller and smaller with every cycle. And so we see that wages have stagnated or actually fallen along with the rest of the economy and along with the velocity of money. And so all this money pools up in malinvestments and speculation. And that leads to this simple conclusion, which is an over-indebted, overcapacity economy cannot generate real expansion. All it generates is additional asset bubbles, which then implode and destroy the latest round of the phantom collateral that the asset bubble created.
Precisely. See, as your point 12 is, really that's where the yield chase is going into things with, as you point out, limited productivity of these assets. And it's showing up and has been showing up for a while now, Charles. Corporations who've been forced to invest or have been forced investing only in the bottom line, not top line growth, because as you point out, the risk associated, eventually the organic growth is not there. They're seeing that, and it's showing up now with the EBITDA, which is the measurement of a corporation's value, its future discounted cash flow. Those EBITDA numbers in this chart I have right up here now shows you have been plummeting, have been falling, and they're close to zero. So yes, corporations have huge amounts of cash, but they're not generating new cash. That's a problem. That's why another reason why they're protecting the cash and they're not investing in capital expenditure and, in fact, are borrowing in the bond markets. But these bubbles are going to pop. But what it's leading to, as you point out, is stagnation. And that maps back, Charles, to this classic cycle of deflation where we really should be leading now to plant closings and debt defaults. But we haven't had that, have we? Yet.
No.
See, and that's where this papering over has protracted and blurred it somewhat. But before we get to that, our old cycle of deflation said we would have beggar thy neighbor and protection and tariffs. And that's why we're seeing today currency wars everywhere in any article you see, and is going so rampant because we have this race to debase. And so we can paper it over. And we're in the midst, we're somewhere between beggar thy neighbor and the plant closings on this particular chart, but it's going to pop. Because the reason that the currency wars, and the currency wars are a trade war, but it's camouflaging something incredibly important that seems to be missed in the press. When you've lowered your interest rates as low as you can go, and they're negative, real rates, as we pointed out, and you've expanded them across the entire duration, which we've done, where do you go from there? Well, the only way you go from there is you've got to differentiate the difference between price and value. And by that I mean the price of the bond, the more it goes up, the lower your interest rate goes down. It works in reverse. So if you want rates down lower, you have to drive the price up, but you can't get the price up. But the way you do it is stop the price, you'd look at value, and that is denominating it in your currency that you're paying it in. So U.S. Treasuries denominated in U.S. dollars, but if you denominated it against another currency, your currency is depreciating. Suddenly that bond has higher value. Therefore, it's more attractive. Therefore, there's a rush to it, even if the price itself hasn't changed. And that's the gig. That's what race to debase and the currency war is really about in the sovereign currency cartel. It's that their only way to offset the debt implosion that they have and to sustain these artificially low yields. Did that pass your common sense test, Charles?
Yes, and it's not easy to understand, though, to see how the foreign exchange market overlaps and influences the bond and stock markets.
And that's precisely why it's not being easily understood. Because remember that the biggest trading market in the world is the currency markets. And then below that is the 800-pound gorilla, which is smaller. I believe there's $5 trillion a day on currencies exchange. And then there's the bond gorilla below it. And then eventually we get down to this little dog called the equity markets. But so these markets are absolutely huge. And anytime we've had major market corrections, they've always been because there's been a realignment in the currency markets. These currency markets themselves are trying to adjust in this world of these currency wars, of this flat out debasement that's going on, which is accelerating. And we saw, Shinzo Abe in his new Abenomics in Japan, where he's going to replace the Bank of Japan's governor so that they can accelerate the rate of printing. This is called the ultimate of reflation. This is all in an attempt, going back to the chart we were talking about, to offset bankruptcies and plant closings because these collateral values aren't there. If the collateral's not there, you're not going to invest in. Maybe the factory's not productive. It's malinvestment. But eventually has to have a market clearing event. Something will break, something will fracture, it will be reset. And then pricing power will be returned. Proper pricing will be returned, and then we will start to expand again. And until that happens, you can't start the road back up. This is just a readjustment that has to happen, and you can't defer it. You've got to, it's like you're sick. You got to take some time off and get better. And we've got to clear this before we can move on to the next stage.
That's right. And the point of this 14-point in-game is that we're reaching the barriers of how this financialization and credit expansion, how much longer that can continue to keep this current system afloat. There is an end point beyond which the system will fail. And that's unknown, of course, but we know we're getting closer.
We're very close. And the system, we've talked about this many times, it's too complex, it's too fragile, it's not robust. Something will fail, some counterparty, and it will cascade very quickly. The difference, too, this time, Charles, is we have callers in the stock market when we have rapid changes and it's some resetting and closures and limits. So we've learned this. We don't have those in the currency market, nor do we have them in the bond market. And a lot of this is such it's never been tested. We've never had tremendous volatility to the degree we could have in these markets. That's when it happens, and it will happen, why it could be so incredibly disruptive. And I personally see that the window is near. But it's a natural and a healthy kind of thing that we've got to go through. We've been artificially papering it over, and you can't continue to do it. The government's tried to buy time until natural growth would come back. It isn't coming back because we have structural issues that are not being addressed. We're well past our time, Charles, as is usual, but a great discussion, a great article. I really compliment you on it. Any closing comments you want to make?
No, Gordon, I think that covers it, that we're just running out of time here, and that we recommend everybody stay alert to these macro issues that we've described.
Charles, you've laid out some of these on what the new changes are going to be and what the solutions are and what the future looks about in your latest book. Do you want to update some of our new listeners on your book? Well,
I'd welcome everybody to come visit my my blog and all my books at of2minds.com.
Okay. Charles, looking forward to it. We'll be back next month.
Okay. Thank you very much, Gordon.
Talk to you. Bye.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.